You brought up earlier before just regarding the legislation changes. Let's get a bit deeper there into the nooks and crannies and what has actually changed. So you mentioned, I think the year of significance is 2017.
Correct.
That's when things started changing. So if you can elaborate on that and just tell us what to look out for.
What to look for, definitely. So we've come out well away from 2017. It's been 5 years. So I think everyone that's listening, most people anyway, will fall under this category, is that if you're buying property today, any property that's residential, owned in an individual and or a family trust, not a corporate entity, will be, under new legislation, unable to claim depreciation on second-hand plant equipment. So you've got a residential property in an individual capacity or a family trust or non-corporate entities, you will not be able to claim depreciation on second-hand plant equipment. Okay? If you buy these houses or residential properties in your company, in a corporate trust, you will be able to claim full depreciation.
Right. So
Okay.
there's
But of course, then there's CGT things to worry about because there's no exemptions on CGT for corporate entities. And that's something you want to discuss with your accountant.
Sure.
Then you've got exemptions around if the old ruling of claiming plant and equipment still is now exempt for warehousing, industrial, commercial, they are exempt from that legislation. So they continue to claim depreciation as per normal. So if you were buying a warehouse or whatever it might be, or an office, even in an individual name, you will still be able to claim second-hand plant equipment on that 50-year-old building as a depreciated asset, and I would value it as a whatever the replacement or the residual value of that asset is. I would value it in today's market and give you a depreciation schedule with those assets. So commercial spaces that's getting a little bit, commercial properties are still getting a little bit more depreciation, but residential have been fall into that new legislation. On top of that, the other thing is capital works, as I mentioned to you, has always stayed the same. So there's been nil change to capital works, which is essentially your building assets of bricks and mortar. They will be under old legislation, which means 40 years of depreciation, 25 years for industrial manufacturing, and they don't change. And that means that, bricks and mortar can be claimed ongoing. I think that really sums up the gist of the 2017 legislation. And it's also important to also know that the legislation is very critical, actually, is if you buy the property prior to 2017, 9th of May 2017, you hold the property as a rental property past that date, but you make it an owner-occupied property at some point after that date, right? So I've rented it out. Then I decide to live in it, right, today. As soon as I rent it out again, it falls under new legislation. It is no longer grandfathered, is the word.
Interesting.
Right. So even though you purchased it prior to that date, you were grandfathered, but as soon as you switch it back to owner-occupied and use it as a principal place of residence, you automatically fall under new legislation. And what I've been seeing people caught up for a lot when it first rolled out the legislation, people were buying their properties, brand new houses, expecting $30,000, $40,000 worth of plant equipment, claimable over 40 years. They were living in it for the first 6 months, claiming first home owners grants, getting a CGT exemption for the 6-year rule. I want to go into that because I'm not an accountant.
Don't worry. We've got disclaimers.
Disclaimer.
Disclaimers in place. This is not financial advice for us.
Training and quality purposes.
And so they came to us and we were advising on the depreciation, and they were like, why is my plant equipment not being added into my plant equipment? And it was registered as a capital loss only. I said, well, that's the legislation now. Because you bought a brand new property, you're entitled to claim full depreciation, because brand new assets, are treated different. They get to claim full depreciation, just like you were to buy an oven from a retailer, Good Guys or Harvey Norman. You claim that asset, right? Well, you buy a brand new building, part of a package on a home and land thing. You could claim full depreciation, but they decided to live in it first, get the grant, get CGT exemptions, then they go organize a depreciation schedule once they rent it out. Then they get hit with, how come there's no depreciation on plant equipment? Only building. And so naturally their depreciation went from 15 grand in the first year down to somewhat like 8.
Oh, wow.
And so that was a big blow, and accountants were like in shock. So there was a bit of a stink around that, but we worked around that and people got used to it. And 5 years on, it's really become part of the norm. But capital loss report, we should get into that, is that if you have a plant and equipment list, what you would have been able to claim would be listed as plant and equipment next to capital works, which is your building. Total depreciation would be the first, plus the second equals your full depreciation tax deduction claim. Right. Now, what's happened is because the plant and equipment is no longer claimable, we've had to move that to a capital loss schedule. And what a capital loss schedule is essentially is this. If you have a property and you're renting it out, and while you're renting it out, you decide, oh, you know what? I want to get rid of the oven, range hood, cooktop. I want to scrap the kitchen. Okay, so I've got rid of all these assets. Now, just because I've scrapped it, I can't claim a tax deduction because they were never depreciable. So they have to be depreciable under Division 43 to claim a scrap value, which I can get into a little bit later as well. But because they've been scrapped and they weren't depreciable, what they can go to is a capital loss schedule. So then, for example, say these oven, range hood, cooktop are worth about $5,000. What they can actually do is, because it's a capital loss, they can offset that capital loss with a capital gain elsewhere. So if they decide to, in their individual name, own this property, and they also have a crypto or shares, if they make a gain of $5,000 in crypto or whatever it might be, in that same capacity, they can write it off with the capital loss. And it just offsets each other. But what happens on the sale of the property is they're going to have to pay it back because of that claim.
Yeah.
Right.
So really there is nil effect, but all they're doing is delaying the loss.
Preventing the inevitable.
Yep. And so that's one of the things that you can do. And in terms of, I was mentioning about scrapping reports, that's something that we do prepare from time to time. And also capital improvement reports, which are, is there enough time to go through?
Yeah, definitely.
Yeah, absolutely.
Absolutely. Let's get
Scrapping
into
reports
it.
are essential because what was happening is if you've got a kitchen, and people do these days, I mean, let's face it, renovations are, and you do a bit of it yourself, as I'm very aware. And, you've got a renovated property, okay, a property that hasn't been renovated. It might be 30 years old, built in 1990, but someone comes along and, they've lived in it for some time. They decide, let's move out of it and rent it out, and we'll do a bit of a, spruik up, and we'll make it look a little bit better. Kitchen, bathroom, there's about 30 grand worth of work, which is great. 30 grand depreciation schedule just for the new kitchen, bathroom, maybe a bit of paint, this, that. Yep. Now, what we can do then is, because of the property initially being a 1990 built property, which means it's eligible for capital works deductions, because it was built after 1987. We've got 1990, 40 years, 2030. There's about 7-8 years left on this kitchen and bathroom that was originally there. Because the original value, say, for example, might be worth $10,000. And we've claimed, over that time, we haven't claimed, we've depreciated up until we left the property, say $7,000. And there's a bit left to go, about $3,000 in the bathroom and kitchen. Now, because we decide to demolish the bathroom kitchen, that $3,000 is depreciable because it's eligible for depreciation when you rent it out, right? So the $3,000 would have been maybe, $400, $500 a year to the remainder of the life of that property. Now, what we can actually do, because we've scrapped it, demolished it, we can claim a scrap value on it. So then, because of that $3,000 we've estimated, quantified, we then put that as a scrapping value for the client, and they claim an immediate deduction of $3,000 effective in the year that they rip it out. So what is the important takeaway from that is, if you're doing works, demolition, and you think there's no value, it's wise to check the build date of that kitchen or that house built, or that renovation or improvement that was done that you want to pull down and redo. You should be checking for the age of it before, and see if there's any residual scrap value left.